Hello everyone, and welcome to another video on financial analysis. And today we are going to be looking at a company called SIG PLC. So here we go. What does SIG PLC do? They are a British-based international supplier of insulation, roofing, commercial interiors, and specialist construction products. They are listed on the London Stock Exchange. And this video is at a request of one of our viewers. So a Brown Town lad, we are looking at this for you. So once again, do remember to like, subscribe and share these videos. So if you subscribe and your video comes up, you obviously get instant notification if you like it. It helps us to kind of spread the word, and do leave any comments as well in the comments box, anything you'd like to add about the company, and also if you have any requests for us. So we are going to be looking at the financial analysis. We're going to be looking at the financial statements of this company and just getting a feel for their financial performance. What we're not going to be doing is looking at the industry. We're not going to look at the company in detail in terms of its contracts, in terms of the management capability, in terms of the the growth potential, etc., etc. So this is just the financial analysis. So if you're interested in investing in this company, this should form part of your core analysis. If you are a value investor, if you're looking at the sort of the ground, the root information and the ground up, rather than sort of momentum investing, growth investing. And also maybe you are interested in, maybe you're going to be supplying to this company, maybe you're going to be buying, you work for this company, you're going to be buying from this company, you're going to be working for this company. So this is all for you to provide some information about the financial performance. So without further ado, let's jump in and look at their annual report and accounts. Now, this is available on their website to download, very easy to find. Just type in SIG annual report and account and you will get them. And you will notice in the annual report and account, very glossy brochure here, and lots of pictures and lots of information about the company. So once again, if you want to know about the company, you want to know about its strategy, what it's up to, what it's trying to achieve, the management, the kind of the corporate governance structure, all of that information is contained within here. Obviously, they're going to be giving you the kind of their spin on it, so you wouldn't just use this as you're the only source of information, but certainly this is a good place to start. However, we are going to scroll all the way down to page 136. So the financial statements themselves don't actually start until you get to well over halfway through this document. So you can kind of see the extent to which they are using this as a marketing document. So here we go. We're on about page 90 by now. We're still going through the kind of, the remuneration of the board, who the board are, the audit report, etc., etc., remuneration, how much the board get paid. So lots of information. And we come then finally down to page 136, where we find the income statement. So here we are into the financial statements, and here is the income statement. So this is what we're interested in. And the first thing we notice is for the top line, looking at the sales, there's the sales, which are about 180, 1.9. You'll notice this is in pounds millions. So that's about 1.9 billion. So these guys are 1.9 billion of turnover, down on the previous year, 2019 was nearly 2.2 billion. So down, probably due to COVID. A lot of construction would have been kind of put on hold or halted before being restarted. So this will be COVID related this fall. The cost of sales, leaving a gross profit, that's a gross profit margin of about 25%. So 25% in this year, 25% in this year. Remember that these cost of sales, generally speaking, not absolutely, but there's a rule of thumb, are variable costs. The less we sell, the less they cost. The more we sell, the cost of sales goes up. So we expect the gross margin to stay constant, and this gross margin is staying constant at about 25%. Now, that looks a reasonable margin for this industry. However, these guys have got very high overheads, and they are consistently high overheads. And as a result of those high overheads, they are making a loss. So you'll notice that this company is making a loss on its the operating they're operating at a loss, which is not so good. So it's loss making. Now, the other thing to notice on these accounts is this number here. So this number here is quite interesting. They actually sold a business, but they made a profit on this discontinued activity. Now, we're not sure whether they've actually sold a profitable business, or whether they are, just don't want to be in that business, or it's a distraction perhaps. And you'll get more information about that within the actual report and accounts, which you can review as you see fit. So the sum total is that the bottom line, they make a £140 million loss, which is a little bit more than the previous year, 125 million. And a lot of that will be down to COVID. But, even in 2019, before COVID struck, they were still operating at a loss, and they were making a loss. So they were operating at a loss, and the bottom line was still a loss as well. So this is a loss-making company, and we are hoping that they can turn it around and turn it into a profit-making company. So let's look at the balance sheet, look at the strength of the balance sheet sitting behind the company. Now, first of all, we see up here, we've got the what we call the non-current assets. These are the things we need to run the business. This is this section here. There's a little bit of a fall, you'll notice. They've got things like right of use assets. This is really kind of things on leases. So, they'll have leased, I don't know, maybe a digger, for example, or a photocopier, and that sits up there. So we'll find that there's a kind of the lease liability will be sitting on the other side of the equation. That's these numbers down here. They've got some property, plant and equipment, £63 million. We'd expect that. The big number is goodwill. So goodwill arises on acquisition of a company. And so what we find here is that, this company, they are, historically, they have been growing and they have a lot of goodwill. And that if you look at note 13, there's a lot of information about the goodwill, about the companies they've acquired, and why they feel justified in keeping that goodwill at that figure in the accounts. So do read that if you have time. They also have some other intangible assets, and these are they're not actually a significant amount. It's 22 million, so it's not a massive amount sitting on their balance sheet, but it is interesting. If you look at note 14, that'll give you some more information about that. And there's some software in there. There's customer contracts which have actually been written down to zero, and there's some other items in there as well. So a little bit of computer software. So quite interesting. Look at those intangible assets. Wouldn't expect to see a lot of that sitting on the balance sheet. Okay, so those are our non-current assets. The current assets, what do we see? Well, first of all, there's a reasonable amount of cash. The cash has gone up since last year, so they're sitting on £235 million of cash. That's good. Trade receivables, pretty consistent, and they've also got some inventory, and none of those numbers look too high to me. So there's no kind of big issues in terms of collecting money or having to pay out money in terms of their inventory turnover. Down here, we've got the current liabilities. There's our current liabilities. We always like to compare the current assets to the current liabilities, and you can see that this liquidity ratio looking very healthy indeed, much healthier indeed than the previous year. So the previous year, they had 822 million of assets, which are either out of cash, going to become cash soon. And this year, they've got compared with 781 million of amounts that they have to pay soon, and this year 700 million of cash, or going to become cash soon, and they've managed to reduce their current liabilities significantly. Now, the reason they've managed to reduce those liabilities is these numbers here. So these numbers here, this is the kind of loans. They've got some bank loans and private placement notes, and what they've managed to do, we can just see that on our screen, is they've managed to effectively convert those into long-term debt. Okay, so that's a much healthier position for the company, rather than having a kind of a loan hanging over you that says you have to repay that next year, and maybe they have to refinance. The management team have managed to renegotiate those loans, and they've managed to turn them into a long-term loan. And details on those long-term loans are contained in note 19 there. So do have a look at that. So Scrolling down our balance sheet, so what we see is obviously as a result of this reclassification, the current, the non-current, the long-term liabilities have increased, and the short-term liabilities have decreased. And as we noted, that is because of this these loans being reclassified, and those are really kind of the big movements there. Coming down to equity, here's our equity. We noticed this company, it's raised a lot of money from share issues, and it's sitting on losses. So it has been making losses, and it continues to sit on, those losses continue to increase. So, this company, ultimately it's basically raised a whole lot of money from the shareholders, and has been making losses. And it needs to start making a profit at some point in the very near future, we would hope. Looking at the consolidated movement in equity, what jumps out at me here, and actually this is last year rather than this year, so we're looking at this particular column here, the retained earnings, and there's the loss coming through, and you can see that they start with a loss, they make a loss, the loss goes up, and then they make another loss in this year. There it is, there's the loss in this year, etc., etc. But what jumps out at me is this number here. This is quite interesting, that these guys last year they paid dividends. Now I don't know why they're going to be paying dividends. They're making a loss. They've been making a loss for a while. So that was a kind of a big question mark, as the decision to suddenly pay out a dividend looked a little bit bizarre to me. But maybe there's a very good reason, and if you know the reason, please do leave that reason in the comments section. So moving swiftly on, here we are in the cash flow section. So in the cash flow section, what we notice here is previous year, so while they were making a loss, they were generating cash. In 2020, they lost cash, and again, that's going to be very much COVID related. That reduction in cash or negative cash flow. So they make an operating loss. They're making a bottom line loss, and they are also losing cash. They've shored up themselves. They've got quite a lot of cash sitting on the balance sheet, which is good. They've got about 4.5 years worth of cash, which is good, although we'd expect them to come back as we kind of rebound out of COVID to at least generating positive cash flow, which would be hopeful. What we notice here further down is that they've also, you'll notice that they have some assets for sale, and they've sold those assets. So they've made a profit from the sale. So there's a divestment. So the investing activities, yes, there is a little bit of investment going on. You notice that they talk about property, plant and equipment and computer software. I'm not sure why this company wants to be buying a huge amount of computer software, but they've identified that. So they have been investing in the company. That's good. And they've been, but a significant amount of the cash they generated during the year has been from the sale of a business unit. And did they sell that business unit because they were under a financial pressure and they needed to generate cash and they had to sell something which was profitable, or did they sell it because it's a change in strategy, or it's no longer part of the core portfolio, or maybe it's loss making and they just don't want it sitting on their books. You'll also notice that they did an equity raise. So they have issued shares during the year, 152 million pounds. This is part of the financing, and the rest of the financing is really this kind of these additional loans, additional debt sitting on the balance sheet. So in effect, the sum total is that they've generated cash during the year. They've increased cash 68 million. That's really the summary of that is that they made a cash loss, but they've sold a business and they've issued some shares, and selling the business and issuing the shares has covered the cash loss and given them an extra 70 million pounds. That's our kind of our sum total there. And so they're sitting on 235 million pounds. And if you have 235 million pounds in the bank and you continue to burn 50 million pounds a year, you're going to be around for just under 4.5 years. But we'd expect them to come back strongly from COVID. So there are the the numbers. There's nothing really else to kind of that jumps out at us in those numbers. So let's go and have a look at the share price. So the share price, here it is. So if we look at it on an all-time high, I'm not sure what happened in the kind of 2007 time, but there was obviously a massive increase. So hopefully nobody watching today was investing at this time here, because you'd be sitting on a significant loss. Obviously, if you bought here and sold out here, then you'd be a very, very happy person, as it went all the way up. And then, of course, it absolutely crashed out. Anyway, this is all very historical stuff, and we're much more interested in the kind of the near past rather than the long-term past. So let's have a look at it here. Here we go. So this is for the 1 year. And we can see that this company has been increasing. So certainly you kind of get a sense that out of the back end of COVID, it's starting to kind of grow. There's there's obviously a good news story, but then since this period, it's come off the boil a little bit. Our market cap is 581 million pounds. There's no P ratio because it's not making a profit at the moment. That represents about a 90% increase or excess over the net asset value. So the net asset value, that's the book value, that's effectively the value of the equity sitting in the balance sheet, is about 306 million. So if you were to buy this business, you'd be creating goodwill of 275 million on a net asset value of 306 million. That's about 90%. So it's kind of it's loss making. I guess the real question is what's the story sitting behind this company? So is it going to continue to make losses? Is there a clear path to profitability? Do you buy into that story? And if you do, then maybe this represents a pretty good opportunity. Remember, this is a company that's making 1.8 billion in turnover, and it's only valued at 500 million, so to speak. So in terms of multiples of sales, that's very, very significant. Sales are very, very high, but it is in a competitive environment. It's a relatively low margin, and it is operating at a loss. So it's got very, very high fixed costs, which it looks to me like that's really the focus of where it needs to bring it down. So there's your financial analysis for SIG. I hope you found that useful and enjoyable. A little bit of information about the company. Again, do remember this, we're just looking at the financial statements. There's lots of information which I haven't covered about the company, about its strategy, about what it's done and why it's done it. And that information is something which you would need to research on in order to work out whether you think this is a viable investment. Otherwise, don't forget to like, share and subscribe the video, and I will see you in the next video financial analysis.